Holger, if we get 50 tomorrow, oddly, is that dovish?
It may be slightly dovish, but I think it's so much expected that that in itself should not be a major market reaction. The market will listen very closely to anything that could give a pointer to what the Fed does in June and what it may be doing thereafter, which, of course, in these uncertain times, we may not get all that much clear guidance, but that's what the market will look out for, any guidance on what happens next.
Well, and in terms of the guidance looking out forward to where they should end the year, for example, Holger, there seems to be consensus that they at least need to get to neutral, maybe slightly above it. Where is your sense of where that is and how far above it they may need to go?
Well, neutral is a very elusive concept. I would say that something close to 3% is probably neutral. But whether the Fed really should get there this year will depend a bit on circumstances. And it's quite possible that the Fed should eventually go above that. We are looking for 3.75 by the end of next year and 2.5 as the upper end of the Fed's target range for the end of this year. And that 3.75 for the end of next year would probably count as somewhat above neutral.
Holger, does the Fed need to retake the narrative back from the markets? At the moment, it seems to be chasing the markets. We talked about 25. The market had already priced in 25. We talked about 50. The market was already there. We're starting to talk about 75. Well, the market's already starting to price that in for the next meeting after this one. Is the Fed still chasing the market? How does it get in front of the market?
Well, to some extent, you could say the Fed is not unhappy and should not be unhappy if its decisions are no longer a surprise because they have been flagged in advance. But you are absolutely right. The Fed is probably paying a bit too much attention to markets. The Fed should communicate more clearly. First, that it is behind the curve. You could say that they should sort of admit they made a mistake last year by not starting the stimulus unwind much earlier, and they should give us a clearer indication what their objectives are, and especially how far they expect to go. We have the dot plots, but a lot that comes from the Fed is a bit back and forth, to and fro. It would indeed be good if the Fed were to be a bit more clear.
Well, Holger, you mentioned the stimulus unwind. Part of that isn't just the rate hike mechanism, it's also a shift to quantitative tightening. What are you expecting to hear around the balance sheet tomorrow? And I asked this question earlier, how much room for surprise really is there within that?
Once again, I think that what the Fed is likely to do tomorrow has been flagged very well in advance. From probably the end of June onwards, they will be reducing their balance sheet by around 95 billion per month, 60 of that in treasuries and the remainder in mortgage-backed securities. Over June, they may be getting towards that. That has been flagged in advance. What is unclear is any indication as to how far the Fed would want to go in the end. Although I have to say, it would probably on that count not be wise for the Fed to be too specific. Simply, we can't help it. The Fed can't help it. We will have in a while to watch how the economy reacts to this unusual thing, namely quantitative tightening. And hence, the Fed should give us as much guidance as they can about what they try to achieve.
Yep.
They should give us good guidance about what is ahead in the near future. But as to the end points, they probably have to be a bit vague, and that also applies to how far this quantitative tightening should go.
Holger, is the current inflation that we are seeing a monetary phenomenon?
In the US, the current inflation is mostly the result of excess demand, more precisely excess demand that came from fiscal policy, but to which the Fed did not react early enough as it should have done. In that sense, the US inflation is very different from the European inflation. In the European side, we only have so far inflation that is imported via energy prices, via food prices, whereas in the US, we have mostly domestically generated inflation coming from excess demand from the government, from consumers, and from a Fed that did not go against it early enough.
Well, excessive demand that is colliding with unavailable supply, given the supply chain challenges that are out there. In particular in places like Asia. So Holger, I'm wondering how you look at China. We obviously saw really bad data coming out overnight when it came to both manufacturing and services over the weekend. Is China a bigger risk to the U.S. economy from a growth standpoint or an inflationary standpoint at this point, given how it feeds into those supply chain issues?
It's difficult to entangle that, whether it's growth or inflation. If there are supply shortages coming out of China, it of course means that our consumers have to pay more for the things that come from China and that less of that is available. So it goes a bit into both, but probably on balance a bit more into prices, especially in the US, than it does into growth in the US.
Holger, you spoke a moment ago about imported inflation. Let's talk about the value of currencies and whether or not they're starting to become a problem. I say there, whether or not the value of the dollar is starting to become a problem for the global economy. And if the Fed goes 50-50, 50-50, or maybe even 75, are we going to see that problem being exacerbated? When does the dollar become a global problem?
There is no clear answer to when it does become a global problem because it differs a lot by region. You could say in Japan, okay, we've already seen raised eyebrows to the weak yen. But for Japan, with its usually extremely low inflation, that is not much of a problem. In Europe, it is not a significant problem that the dollar is a bit stronger, the euro is a bit weaker. That does not add very much to Eurozone inflation, maybe 0.1, maybe 0.2 percentage points. But for some emerging markets, this could be a significant problem. The rule remains if you have borrowed too much in US dollars and don't have enough export earnings in US dollars, then what we are seeing in the stronger dollar and in the Fed rate hikes is potentially a significant problem for not the global economy, but for some parts of the global economy, especially in emerging markets.